SWOT analysis is a technique for determining the strengths, weaknesses, opportunities, and threats of a crypto project according to a four-quadrant structure. Now, the background of SWOT analysis is quite technical, and actually no one really knows who came up with it, but it does help you to determine the accuracy of your investments and can be combined with the investment potential checklist to really make sure that you understand and know the opportunity and landscape of your crypto investments. So the quadrants look like this: strengths, weaknesses, opportunities, and threats. And you can do this in terms of doing it via the quadrants, which will give you a good overview of your crypto projects in terms of thinking whether they're helpful, harmful, whether they're internal origin, so based on the actual design and implementation of the cryptocurrency, or whether they're from external threats. So a typical example of this would be a government or regulatory body wanting to impede crypto development for their own gain, etc. Whereas internal origin would be the number of tokens, for example, that exist, and therefore the viability of the opportunity available. I'm going to be comparing and contrasting two different cryptocurrencies using this system to give you a flavor and an idea of how it works. The end game ultimately is to back up your internal judgment using this system. So if you see a crypto project you like the sound of or you want to invest in, this will give you the logical reasons as to why it's a good or bad investment, and you can make your decision based on this in terms of the investment potential checklist as well. So let's just have a look here. So if we look at Bitcoin, okay, the strengths of Bitcoin are that it's one of the most popular cryptocurrencies, if not the most popular, and therefore it has the largest number of users and the largest trading pairs. So, for example, for Bitcoin to fail, the largest number of people would have to declare it valueless. Okay, that's not going to happen. 8, 10, 12 million people all declaring that one asset is of no value is very unlikely to happen, and therefore it has a strength. Another strength of Bitcoin is it's the first crypto, and therefore it's the longest running blockchain project in history with no errors. That means it has over a decade so far of running history, and that really speaks to it running for the next decade and then the decade after that, etc. So therefore, it's got longevity, it's got a history, and it's not been killed by any particular attack that's been laid on it so far. So therefore, it has a resilience to it. Another strength is a low number of tokens, a low number of units, 21 million, in comparison to some other crypto projects. And this makes it a deflationary asset. So the more money that effectively gets invested in it, the stronger the project. Okay, so the longer it is around, the more people that know about it, the more money that pours into Bitcoin, and the more people that own Bitcoin, the stronger it gets. Whereas most other assets in history, if you look at gold, property, etc., the more money that goes into it, the less value it is. Okay, because there is a inflationary element to it. Weaknesses: we don't know the creator of Bitcoin. Satoshi Nakamoto is still a pseudonym, it's still unknown, and therefore there is a little bit of a risk there. Because if Satoshi Nakamoto turns out to be someone who's politically unfavorable, or turns out to be a team of people that society would judge to be not particularly beneficial, then if that comes out at a later stage, that could affect the price. Also, Satoshi Nakamoto to this day owns over 1 million Bitcoin, so therefore there's a large number of cryptocurrency units focused on that unknown creator, and we don't know who that is. So that is both in terms of intrigue and mystique, that has done something for Bitcoin, but also it is a weakness when you're looking to invest in an asset. Ideally, we would know who everyone is who owns a particular cryptocurrency project, at least in pseudonym or via another entity, okay? But for this instance, we don't. Naive adoption. So when Bitcoin came around, in the first 5 years of its existence, a lot of people just bought in and bought, a punt amount of cryptocurrency. That is a problem now, because obviously if people have lost their wallets, or if they're just holding on to them for a long time, that means there's a large amount of liquidity that's locked up, either inaccessible, or if it does become accessible, it's going to affect the price, because a large number of units have been accrued to 3 million, effectively, whose owners have become wealthy very, very quickly and therefore are prone to making poor decisions, selling out at certain intervals. There are people who track the oldest wallets in existence on Bitcoin, and whenever they move or when there's a transaction that goes through those wallets, it is reported on Twitter, etc. So we can track these to a certain degree, but in terms of naivety and adoption, Bitcoin has the largest because it is the longest and also was relatively inexpensive for the very first part of its use and adoption. Now, there were people who obviously didn't buy down at the bottom when Bitcoin was sub $100 or even $1,000. But the people that did and have held are very few and far between. But those people do obviously have a lot of sway within the network and within the system overall because they own proportionally quite a large amount of the network. Bitcoin is also environmentally and fee inefficient. If I want to send crypto exchange to exchange, I wouldn't use Bitcoin. You'll pay $20 to $30 in fees just for doing that, and also it takes around about an hour to do. Okay, so it is relatively inefficient, and also because of its design, it's not the most environmentally friendly cryptocurrency because its focus on mining becoming exponentially more challenging as the life of the project extends. So at some point, it will be unenvironmentally economical to continue to mine Bitcoin, but that might not happen for 100, 200 years effectively. Okay. So at some point in the future, most people are going to decide that Bitcoin is environmentally unreliable and not worth the energy invested in it, but that is a long way off at the moment. And obviously, in terms of its use, you can't really beat it at the moment in terms of security, network adoption, etc. Okay, but there is a price to obviously pay for that. And I believe post rapid expansion. So I believe that the majority of returns that could have been made in Bitcoin have now passed. So owning it for $10, $20, $30, etc., obviously is going to get you a larger return than 3,000, 4,000, or even 30,000 to 40,000 because the amount of percentage gain is a lot smaller at these prices than it is down at those other prices. I don't think there's, 20, 30 times return still left in Bitcoin. Okay. For that to happen, it would have to be worth over $1 million a coin. And that would make it one of the most expensive asset classes in the world, if not ever. So, looking at it rationally and looking at it in terms of the tokenomics model, I believe it is post rapid expansion. Let's look at opportunities now. It is considered a safe crypto, if not the safest crypto, because it has the largest user base and it also has the longest running history. Okay, so that considers a safe, but you pay for that because you're not going to get the out of the world returns that something that is quote unquote unsafe is going to provide. It is relatively trackable. According to a stock to flow model, this is the model that says that there's going to be a predetermined amount of Bitcoin mined for the future and actually tracks the price. And in another video that you can probably see on my YouTube channel, I will analyze the stock to flow model. But effectively, we can determine the likely price of Bitcoin at any given point in future according to its release schedule and the amount of capital flowing in. So there is a predictability to the price of Bitcoin. And also it's insured by the size of the network. Okay, so there are quite a few hodlers who just want to hold and hold and hold. It will never sell, basically. This means the price is likely to always increase for the foreseeable future until a critical mass is reached where the consensus around the network actually switches to being risky and unviable for the project to develop. At the moment, we're very firmly in the camp of the development of the network and the continuation of the network. So therefore, it is insured by the size of that network. If there was another crypto project that had a much smaller network, then that wouldn't be the case. It's easier to get 1,000 people to believe that something is not valuable than 100,000 or even 1,000,000 people. And the size of the Bitcoin network at the moment is in the tens of millions, as opposed to thousands. Threats. So naive wallet inflation, I've already said that. So in terms of money being created out of nothing, effectively, you bought 100 Bitcoin for, $500, $1,000, etc., and it's now worth a huge, staggering amount of money, a life-changing amount of money. You're going to want to sell that theoretically, if you don't really understand or know about cryptocurrencies or are not invested in them for the future, and that's going to take a huge amount of liquidity and capital out of the network. Government regulation. So, this is the ongoing fear that the governments of the world are going to turn around and blockade or at least restrict cryptocurrency access for fear that it's going to be undermining their governments and their regimes. So, this is a little bit of an issue and it's usually overblown in terms of what pundits usually say, because as soon as something is banned by most governments around the world, it becomes more attractive to its citizens than anything else. So we have a little bit of a problem here in that, yes, governments have been taking notice. Usually their response is to tax crypto assets as opposed to ban them. The governments that have banned them around the world have usually, within a very short space of time, unbanned them or at least regulated them and changed their very strong stance very quickly. But then, nevertheless, there is a element of risk with government regulations. Some crypto projects are still not viable in certain territories. So, somewhere in the States, someone might not be able to trade a certain cryptocurrency for various reasons, state by state basis as well. And definitely in some countries of the world, crypto assets are still very, very early on in terms of government intervention. Fortunately, in the part of the world where I live, the UK, it has one of the most relaxed approaches to cryptocurrency in the world, and we just get taxed a lot on them whenever we make significant profits. And prone to open source attacks. So obviously, Bitcoin is a open source network. It is an open source environment that has pluses and minuses. Pluses in that anyone can change the source code and develop and help the project, but also anyone can hinder the project if they decide to do something malicious or nasty. Now, obviously, that can be replicated and resolved by the network. So as soon as anything does happen that would be problematic, it would be relatively straightforward for someone to fix in the network. But there is always that risk with open source projects that something could go awry that is beyond the capability of the network to resolve. So there's that element of risk in there. Okay. Now, a lot of people, as we'll see in the next section, prefer open source to proprietary just because open source has a larger network effect. So there are many more people wanting to contribute to an open source project than obviously a proprietary project, because proprietary, everyone is on the payroll and everyone is getting a benefit basically from it. There's a vested interest to develop, but there's also a vested interest for profiteering along the way as well. So Bitcoin is an open source network, and that is favorable for the time being. But obviously, it does have elements of risk and threat to it, because anyone can change the source code, much like Wikipedia. On Wikipedia, you can go in and change any of the articles unless they're locked, okay? And if you do that, you can make up any information. And there's been some comical history with Wikipedia with certain things, and obviously some problematic history. But by and large, the open source project is reliable because within a very short space of time, someone can actually come and rectify that if it is a problem. Now, sometimes these problems don't get noticed for a very long time. But in the grand scheme of things, Wikipedia is still here. It's still a project that people know and trust. It just has that caveat of open source nature, and therefore you have to be a little bit more cautious about what you read and corroborate your information. So let's compare it and contrast it with another project, CRO, the Crypto.com proprietary token. So the strengths would be, this is a token of a well-known crypto project with millions of users and 1,500 employees. You know, if this project was to cease to exist, then those 1,500 employees wouldn't have a job and millions of users would lose their money. So therefore, it's likely to continue to exist, at least for the time being, or at least not disappear very quickly, so quickly that you can't do anything about it. There is a high lockup rate with the stake rate, so card tiers and DeFi liquidity require quite a large and long lockup period, which means people can't sell their assets. So therefore, once again, this is a strength because it's going to prop up the price and it's going to make sure that your investment, if you are to make one, is protected to the downside, at least to a degree. Another strength is that it's an own blockchain, so it's proprietary. Okay, so it's cheap, fast, and very liquid. The fees are very low. It doesn't use Bitcoin, it doesn't use Ethereum, and therefore the bottleneck effect that is privy to some of those cryptocurrencies doesn't really exist. And there are attractive perks for ownership, so a percentage on cashback in terms of purchases. There are numerous opportunities to invest in other cryptocurrencies. There are trading incentives, etc., etc. So there's lots of attractive perks for owning this particular cryptocurrency. There's rebates on Netflix, Spotify, etc. Weaknesses, proprietary. So if Crypto.com fails, CRO is likely to go with it. There is no use case really for CRO unless Crypto.com exists. The use case for Bitcoin is much more varied. You know, it could exist in any shape or form, and its one purpose is to facilitate global transfer of money. Okay, whereas CRO has many use cases within Crypto.com, but if Crypto.com fails, then there's not really much of a point to CRO. There's also a large supply of 30 billion coins. This was 100 billion, which made it much less attractive, but now there's a relatively large supply of 30 billion, which means, again, the tokenomics aren't really massively favorable for a huge increase where the price, does 1,000 times. Opportunities. It's relatively inexpensive at sub $1. Okay. We are looking at an opportunity for it to be several dollars within a very short time frame, and at the moment it's around about 15 to 20 cents. So you're looking at 25 times return comfortably if the project is successful. There are numerous crypto partnerships and public relations exercises. So Crypto.com have a marketing department, and that marketing department is going to help the token appreciate in price from a distance, at least disconnectedness. In terms of, it's going to be at length. Okay, so if Crypto.com sponsors a sports situation, a sports game, a sports team, then this situation is going to push the price of the asset up because a number of people are going to see CRO in the limelight and therefore want to invest, etc. As I've already said, there are a high number of ownership perks and there are generous rates of return, 15, 20, 25% occasionally. But you have to own CRO in order to access those, and you also have to lock up some of your crypto in order to do that. So if you want to own the card, for example, you get 12%, but you have to own a huge number of tokens in order to get that, which helps with the longevity of the project. Threats. There are other exchanges and tokens, namely Binance Coin, BNB, which does pretty much the same thing, but in the Binance ecosystem. There are also stronger coins, BNB being one of them, because it actually has its own smart chain and even projects developed on it. So there's the capability for smart contracts, for example. So BNB is probably 2-3 years ahead of CRO at this point. That doesn't necessarily mean that it won't catch up CRO and actually overtake BNB at some point in the future, but it's worth knowing. And ideally, if you want to own some BNB as well as a hedge, that's obviously a good thing. But I would say that BNB is the proprietary forerunner in this race for proprietary tokens for crypto exchanges. Just because BNB, Binance, is bigger and more widely used. Once again, government and regulation. Okay, so with a proprietary token, it's even bigger because obviously the SEC or the FCA could come in and say, well, this looks like a stock or a share, as has happened with Ripple, and that can really affect the longevity of the crypto project because when you're offering perks and returns in terms of ownership, then that does look like a security as opposed to anything else. Whereas with Bitcoin and Ethereum, they have no proprietary entity behind them. So therefore, to make the argument that they are a security doesn't really make sense because who's the benefactor at the end of it? With Crypto.com, obviously, if 100 people invest in CRO, Crypto.com will benefit in some way or another. Once again, proprietary decision making. So if Crypto.com decide that CRO doesn't really fit their landscape anymore, they can get rid of it. And that's what happened with MCO. or Monaco token, which was the first proprietary token of Crypto.com before its rebrand. They decided within 24 hours that that was no longer going to exist, and they were going to offer a switch incentive to switching to CRO. So that is the risk you take when you're dealing with a proprietary token, is that the decisions are very swift and very fast acting, because the ownership of the token is effectively controlled by the proprietary body that's created it and implements it and manages it. Now, there is a plan for Crypto.com to decentralize CRO and make it more open source, but at the moment it is very, very proprietary, very, very controlled by Crypto.com and the board of executives and the management team behind it. And there is also a lockup required for benefits. So if you want the card tiers, for example, you have to lock your CRO up for 6 months. During those 6 months, obviously, you are unable to sell. So if something negative takes place in those 6 months and the value of your investment plummets, you can't do anything about it. And that's obviously a risk that you need to take and calculate. Now, after those 6 months are up, you can sell at a moment's notice, which is a good thing because you can get out if you need to, but you obviously have to keep that stake locked in order to achieve the benefits. So there is an opportunity cost if you do exit at that point, because you'll lose the benefits. And usually, at least for me, if I decide to sell and rebuy, I would need to invest 4 times the amount in order to get the same level of benefits, because I got in at a relatively early stage because the risk was much higher. The tier structure was a lot lower. So understanding crypto projects in terms of SWOT analysis can actually really help you flesh out your understanding and your risks and your opportunities in terms of what you want to invest in. You can use this in combination with the investment potential checklist to make sure that you are understanding where your cryptocurrency money is going and why it's going there. Okay. Now, these demos that I've just run through here are just an example of the type of analysis you could do. You could actually extend it further. You could have, 10 strands for each of the 4 quadrants. And you could even compare and contrast. So if you're thinking about 2 different cryptocurrency projects and you want to invest in one or the other, you could do a SWOT analysis for both and go with the one that has the most strengths and opportunities and the lower number of risks and threats and weaknesses. Okay, so that would help you to decide where to put your money and where you're going to make the most opportunity with the minimal amount of risk.